Hi, folks. Welcome to another edition of Money and Politics Now. And as a reminder, I want to tell you that I am not a registered broker or financial advisor. I am an investor of 40 years, and I am trying to share my own personal experiences and what information I can give you for the purposes of information and education, some of which I've learned over the years and some of which we're going to be learning together. And with that, I had in a recent video that we put out an important question come in from one of our viewers, and I wanted to bring that up because it's an important question. After you find a monster company like this one, and she was referring to Humboldt, ticker symbol TSNP at the moment. After you find a monster company like this, do you still feed the other ones that you feel are just as good, or do you get a better position in TSNP? It's a very good question. How do you kind of put together your portfolio? And with that, I wanted to address it to everybody. And so here's I'm going to use some analogies because I think they're very good in kind of crunching the concepts and giving you the idea. Let's say that you're the way to look at putting together your portfolio is if you're the manager of a baseball team. I happen to be a St. Louis Cardinals fan. It doesn't matter. The point would be you're going to be the general manager of that team, and you're going to be looking at the talent you have on the team. And our portfolios are kind of like that. We might have 10 positions, 5 positions, 20 positions. You should be looking at how those positions are progressing. Some are going to go up 1%, some will go up 30%, 100%, some are going to lose 20%. So you want to look at those and keep your eye on them. Now, if you buy something and it goes down, that doesn't mean that you should necessarily sell it. There's no one good answer to answering the question. Should you put more money in something like a strong growth company? In this case, we were talking about TSNP. It could be something else. My short answer is what you should do is try to balance your portfolio. And as I tell people, you don't have to choose between growth and safety. You can have both, but it's how you structure your portfolio altogether. So first thing, one thing I would tell people that they would be well advised to do is to always keep cash in their portfolio. Don't become 100% in the market. I would advise that you keep somewhere between, depending upon circumstances, 10% or more, but maybe a minimum of 10% of your portfolio in cash. So if you have $10,000, have $1,000 in cash. Now, why would you do that? A lot of times stockbrokers, and I have some friends who are stockbrokers, so I'm not going to knock them all, but they're not all created equal. And there's some very bad stockbrokers, and a lot of them are going to go, hey, why don't we put that cash you have to work? So number one, let's start with the cash. And my response to that, if someone tells me, why don't we put that cash to work, is it is at work. Cash is a position. That's one of the things you want to learn. Cash is a position, just like if I have money in Facebook or Amazon or something else. There's two good things that cash will do by keeping it in your portfolio. Number one, when we have a down day, and as I tape this on the 28th of January of 2021, the previous day, the market was down about 2.6%, the Dow was. So when you get those down days, if you know you have cash in your portfolio, it's going to give you a sense of security. And the other thing is, if we get a period of time where the market goes down for a longer period of time, if we have a correction, and they could be down 5%, 10%, 20%. And as I say, this is January 2021 as I'm taping this. Back in January of 2016, we had the market just fell down precipitously in January, and it really was pretty tough sledding. The market stayed down for about 6 weeks. But you know what? 2016 ended up being a pretty good year for the market to be invested, but it was just horrible in the beginning. So when you have cash, that gives you some security that you're not going to panic, that you're not going to necessarily sell out of panic. A lot of being a good investor is to learn to control your emotions. So you're going to get excited, you're also going to get fearful. And I tell people, when you're investing in the stock market, every day it's a tug of war between greed and fear. And you can have a long period where the market's down, and you can have sometimes where it goes up and down day by day. There was one period of time, and I think this was like July of about 2017, might have been 2016. I remember that it was one of the weirdest, in my 40 years of investing, weirdest weeks as far as the way the market was performing. But it goes to show you how irrational the market can be. Out of the 5 days that we had that week in July of whatever year that was, a couple of years ago, every day the market went up or down by 100 points or more. So like on Monday it was up, let's say, 150 points. And then on Tuesday it was down 200 points. And on Wednesday it went up 300 points. Every day it reversed by at least 3 digits. So as an investor, what do you do with that? You ignore it. And that's as far as just learning to manage your funds. A lot of time it's just ignore it. Don't get too caught up in the day-to-day. I don't want you to be day traders. That's not my game. My game is time is on your side, buy good stocks and let them grow. You know, day traders are like someone who plants seeds of corn and then go out the next day and want to pick an ear. That's not how investing works. You plant your seeds and you let them grow and you let them grow. And after a while, you're going to have a good harvest. Now, I'm not really yet answering the question that I was asked. How do you know whether to put more money into one position or another? Let's start with what we know. What we know is that we don't have a crystal ball. We don't know what the next day or the next week or the next month is going to bring. Nobody knows that. So if you have a stock like TSNP, which is a fast growth stock, it's a newborn, you might say. The company is really just coming together here in January of 2021, has a great plan, great management, I think a great product that they need to roll out. You can get all excited and want to throw all your money into that. That would be a mistake. No matter how good something is, you don't want to extend yourself too much into one position. I have more than I normally would have personally in TSNP. I do own it. I have a great, pretty, 5 figures in that position. But here's the thing, I have other positions as well. And right at the moment, because the market is also at near highs, I have about 50% of my portfolio right now in cash. So I'm not just taking cash and dumping it into TSNP, even though I think it has great growth potentials. When we're managing a portfolio, you want to look at it, as I started to say, as a general manager of a baseball team. Now, you're going to have some stocks that come out like gangbusters. And you're going to have, let's say you're the manager of a team, you have one player that comes out and they're just doing great for a while, 3 years, 5 years. After a while, they're going to quit being great. Their performance is going to slow down. And that's where, are you getting the production out of that stock? So with TSNP, and let's just use that as one example, I took a good position in it, and I'm going to let that grow. I'm not going to worry about it going up or down from one day to the next. I'm going to look at where it's going really over years, but right now over months. And the story is good at this point, so unless the story changes, I'm not going to be playing around with it. I planted my seeds and I'm going to let them grow. On the other hand, there are other positions out there you might want to take advantage of, and you're only going to have so much money no matter how much money you have. So you want to be able to keep some money to put in other positions. If you're not as sure, then you can take a couple, you can buy five stocks, 5 shares, 10 shares, 20 shares, whatever you can afford. And you want to have different positions so that each of those creates an opportunity for you to grow money in other areas. And so if let's say for the sake of discussion, TSNP takes off and goes from about 35 cents where it is, 37 cents or so where it is right now, let's say it goes to $10. I mean, you can look back and go, oh my God, I wish I would have put more money into that. Well, you wouldn't be saying that if something drastically happened to the company and it went down precipitously. So because we never know, we have to take our best guess and position our portfolio to put ourselves in a position to win, but then also to take the opportunity to have other stocks grow as well. This idea of how you put together a portfolio, let me say, there's no one way. What I tell people, and I'll probably do a separate video on this, but let me give you my thoughts on just in general putting together a portfolio. First of all, I've used the example before of if you think of visualize your average strip mall, and what do you have? You have a grocery store and you have a bunch of small stores. So the grocery store is the anchor store. And then you have a barber shop and a gym and a pizzeria place and maybe a tax accounting place, a little cafe, all these little stores. When we put together a portfolio, we want to have our anchor. Our anchor, just like the grocery store, could be where you buy the S&P 500, you buy the NASDAQ, by buying ETFs, those are exchange-traded funds. And exchange-traded funds, if you don't know, are basically like where you can buy the entire American economy by buying the S&P 500, which ticker symbol SPY. And last year that went up 16%. Well, that gives you the diversity by buying that one unit of 500 different companies, 500 of the biggest companies in America. So you can play with the numbers, and you might say, let's say we had a $100,000 portfolio, to make that simple. Of my $100,000, maybe I'm going to put, first of all, let's say we're going to put 45% into our anchor store. And of that 45%, perhaps 30% could be the NASDAQ, ticker symbol QQQ, and you could have the balance, I think you could have the S&P be 15% or 20%. You can play with these numbers. And again, S&P 500 is SPY. Well, when you're buying the indexes, you're not going to get a grand slam home run. And here and there, you want to have a grand slam home run. And TSNP, I think, is one of those stocks that might do that for you. So you want to put yourself in a position to buy some individual stocks. Now, when you buy an individual stock, remember that there's more risk to that because you're not diversified. That's a one company risk, as I say. If you bought any company, if you bought one company, like imagine, let's say Apple. If we had bought Apple back when it was just 5 years old or so, what if Steve Jobs had died in a car accident? How would that have impacted Apple back then? It would have impacted them dramatically, right? So anytime you buy one company, anything can happen, even when you have a good story, a good product, a good management team. And you don't know what risks are out there. You can't analyze every single risk. We had 9/11 happen. We've had the COVID pandemic come out of the blue. Look how those events happened to impact the market. And those had nothing to do with our judgments on what the stocks we have in our portfolio would happen. So you have to You have to know that bad things are going to happen in the world, and they're going to have an impact on the market, and you got to protect your investments by putting your portfolio together accordingly. So as I say, you have money in your anchor store, then you have about 10% in cash. So if we had 45% in our anchor, we have 10% in cash, that's 55%. That leaves 45%. Then let's say we have 10 other positions. Think of them maybe as different 10 different buckets. You're going to put from 1 to 5% of your money in each one of those buckets. If one stock is a little riskier, maybe you only put 1% of your portfolio in there. If another stock is a little more stable, you can put maybe 5% in there. So you're going to put yourself in a position where if you get one of these stocks that goes, as I say, a grand slam home run, it goes to the moon, one of those, or certainly two of those in your entire career could make you financially stable the rest of your life. That's one of the things I tell the story that I did back about 25, 30 years ago when I bought Cisco Systems when it was a relatively new company. And the internet just came out in 1993, and Cisco for the first 5 years that I had it just grew and grew and grew. It just took off, and I made a lot of money in that investment. That's what you want to find. But you're not going to be able to go and hit a grand slam home run every time you invest. So your expectation should be that you're going to pick winners. And to stay with the baseball analogy, you're going to get some singles, you're going to get some doubles, you're going to get some triples. You might get a home run, but it's rare that you're going to hit a grand slam home run. So by having maybe 40% of your portfolio in these individual buckets, you're going to put yourself in a position to have some real winners, but you're also limiting the downside, because if one of them all of a sudden has some disaster happen and that goes bankrupt, which would be the worst case scenario, it's not going to destroy your entire investment, all your wealth, because you have different positions in your portfolio. The risk is going to be limited to that one position. Okay, one last thing. If we have some real bad news come out in general, the president has a heart attack and dies, we have some other, maybe some major conflict, an oil embargo comes out. Things can happen and have happened. They come out of the blue. If our whole portfolio goes down, you have to be able to just hang on and not panic. Just because your portfolio goes down in value doesn't mean that you've lost that money. If you bought 200 shares of a stock, you still own 200 shares. So the value of that 200 shares might have gone from being worth $1,000 down to $400, but it doesn't mean it's going to stay down at $400. If you panic and sell when it's down, you locked in a loss. So if the story is still good, if the management is still good, if you have reason to believe the stock is going to continue to make money, then hold on to it. And maybe that's the best time for you, if you have some extra money, to go in and buy more. As I said, the thing about having cash in our portfolio does two things. One is it gives you emotional security for these ups and downs in the market, that you go, I'm not going to panic, I got cash. The other thing is when something falls, and let's just take about a year ago, is the first time we began to hear of COVID. When we got to St. Patrick's Day, that was right about the low of the market. That's when you take your cash and you start buying great bargains. As I tell people, when do you want to buy a Cadillac? When it's worth $70,000 or when it's worth $15,000? If a market takes a deep hit and it pulls all the stocks down, well, then go bargain hunting. Go buy those Cadillac stocks, that are now on sale for $15,000 when normally they'd be $70,000. That's the other reason you want to have cash. Because if you're fully invested, the only way you can buy something is to sell some other position to raise cash to buy a new position. But likely you're going to be selling that position at a loss. So by having cash, you're not going to have to sell positions at a loss. I hope this is clear. It's a very good question that was asked by one of the viewers, and this is why I encourage you all to ask questions, make comments. I'd be happy to address them as best I could. I don't know if this has been helpful. I hope it is. It's a good question. It's not the easiest question to answer. And as I said, there's no one perfect answer to it. My best summation would be keep looking at your stocks. If it still has good growth prospects, then stay with them. But the other thing is, if sometimes you might just sell as something grows, sell 1 share, sell 2 shares, sell 5 shares to raise some capital, take some money off the table. One of the 10 commandments of investing that I would tell people is the greatest thing about the stock market, or one of the greatest things, is you don't have to buy all of the shares at one time, and you don't have to sell all of the shares at one time. If you remember one thing out of this video, remember that. You don't have to buy everything at one time. You don't have to sell it all at one time. As it goes up, you can sell some. If it goes back down and you got that cash, you go in and buy those shares at a cheaper price if you want. But if it continues to go up, at least you kind of took some money off the table, and you can use that cash for something new you want to buy. There's always going to be other opportunities come along, and you don't want to just think, this is it, this is the one. You don't want to become married to stocks. You have to be controlling those emotions, and remember, you're basically the manager of a business. Your portfolio is something that's going to make you money, and you want to be a good manager of that business. So I know that kind of rambled a bit. I'm sorry for that. Hopefully that helped. I wanted to knock this out while I had the time. A lot of times I'm doing a video at midnight because I have a day job, which I hope you can appreciate. In the meantime, please keep your questions coming. Thank you for the views. If you haven't subscribed, please do subscribe. We're going to be doing a variety of things as we grow the channel, which is brand new. We're going to be interviewing new investors. We're going to be interviewing from time to time some business executives. I'll give these talks, which you may or may not like. You can let me know if you don't like this. If you think I just rambled, let me know that too. I mean, I can always improve, and I trust and appreciate your feedback, positive or negative, all right? So please do subscribe to the channel, share the channel, like it, and also please leave us a comment. Thank you all so much for spending part of your day with me, and good investing, everyone.